My name is Lisa Kinsella. I'm a partner in the tax department at Crowe. Three of the most important things that we get asked from individuals returning to Ireland from the Middle East are around the area of termination payments, offshore fund investments and the tax implication of those, and whether it's appropriate to rebase their assets before they return to Ireland. So the first area that we're often asked about is around the tax treatment of termination payments. Very often individuals that have been working out in the Middle East for a long period of time will be entitled to a substantial termination payment when they leave their employment. It's important to understand whether that payment is a contractual obligation or whether it's been paid outside of their contract. It's also important to determine the timing of that payment. We will work with the individuals prior to their return to ensure that they can avail of reliefs such as split year treatment, and where those reliefs are not available, we will work with the individual to ensure that they don't become tax resident in Ireland in the year in which the payment is actually made. The second area that we get asked about a lot is the tax treatment of offshore fund investments. Very often these individuals have built up significant wealth and they've paid little or no tax on these because of the location in which they reside in. Ireland has a very complicated taxing regime when it comes to offshore funds. So it's important that these individuals are aware of how these investments will be taxed when they do become tax resident in Ireland. If this doesn't suit their particular profile, then it may be appropriate to dispose of these investments prior to them becoming resident. The final area that we are very frequently asked about is around rebasing assets that individuals have acquired prior to their return. Very often these individuals have substantial investments in stocks and shares, as well as the offshore funds that we've already mentioned. These gains, if disposed of when they become resident in Ireland, could be subject to substantial amount of capital gains tax. So it may be worthwhile disposing of and reacquiring these investments prior to their return. On the flip side, these individuals may also hold investments that are loss-making. It might be more appropriate to retain those investments until they actually return to Ireland and become resident, at which time they could then be disposed of to generate a loss that could be used to shelter gains on future disposals. One final point to note about rebasing assets is that very often the assets are owned jointly by a husband and wife, and in some cases, for personal reasons, one of the spouses returns to Ireland ahead of the other spouse. In that case, they may become resident prior to their spouse who's remained abroad becoming resident. Assets should really be disposed of before both spouses return to Ireland to ensure there are no negative tax implications. For more information on the topics that I've discussed today, please click on the link below, or please feel free to send us an email.